Adobe just lost 44% of its value in a single year. Not during a recession, not during a scandal that torched the brand. During what should have been the best stretch of its entire history. With record revenue, record cash flow, and a product every creative professional on earth still opens every single day. Wall Street looked at all of that and decided to sell anyway. Shares dropped as much as 26% just since the start of this year, and the stock is now trading over 40% below its 52-week high, more than 60% off the all-time record it set back in 2021. Goldman Sachs slapped a sell rating on it, HSBC slashed its price target. And in March, the man who built modern Adobe, CEO Shantanu Narayan, announced he was stepping down after 18 years at the helm, sending shares tumbling another 7% in a single afternoon. This is a company with a 36% profit margin, a company posting record quarterly revenue 5 quarters running, with more than $26 billion in total annual recurring revenue on the books. And somehow, none of that has been enough to stop investors from treating Adobe like a company on its deathbed. So what the hell is actually going on? The short answer is that Adobe has spent the last 2 decades building one of the most profitable business models in software history, and artificial intelligence is threatening to make the entire thing irrelevant. Adobe's real business was never really Photoshop or Illustrator. It was the moat. For years, if you wanted to make a living as a designer, a photographer, or a video editor, you needed Adobe's Creative Cloud, full stop. There simply wasn't a serious alternative, and Adobe knew it. That's why they could raise subscription prices basically whenever they wanted, and why they built a habit out of making it deliberately difficult to cancel. The Department of Justice and the FTC eventually caught up with that one. Prosecutors alleged Adobe collected billions in early termination fees over the years by burying them in fine print and forcing customers through phone transfers designed to wear them down before they could actually cancel. In March, Adobe agreed to pay $150 million total to settle the case, split between a direct payment to the government and free services for affected customers without admitting any wrongdoing. But the real threat isn't a fine. It's that the moat itself is drying up. Generative AI can now produce a usable image, a rough video edit, or a marketing headline in seconds, and it doesn't care whether you've spent 10 years mastering the pen tool. The entire value proposition of professional creative software was that it took skill and time to use. AI just deleted both of those requirements. Bank of America has openly argued that AI will structurally pressure Adobe's ability to keep monetizing the way it always has. One analyst covering the sector put it more bluntly. Application software faces an existential threat from AI, full stop, no caveats. That single line was reportedly enough to convince at least one major fund manager to sell down almost its entire stake in Adobe and several other software names in the same week. Adobe, to its credit, saw this coming and didn't just sit there. It built Firefly, its own generative AI engine, and folded it directly into Photoshop, Illustrator, and Premiere so that the moment any of its 32.5 million Creative Cloud subscribers opens the app, the AI is already sitting right there waiting. Firefly has generated more than 24 billion assets and holds roughly 29% of the entire AI design tool market, ahead of Midjourney, Canva's AI, and DALE. Adobe has also gone out of its way to meet users where they already are, striking a deal to bring Photoshop, Express, and Acrobat directly into ChatGPT, and deepening a partnership with NVIDIA to build the next generation of Firefly models and so-called agentic workflows, tools that don't just generate an image but carry out entire creative tasks on their own. Adobe's own numbers back this up. AI-first annual recurring revenue more than tripled year over year, and management raised full-year guidance to as much as $26 billion in revenue. On paper, that sounds like a company successfully outmaneuvering the disruption. The problem is that success doesn't look the way it used to. Freemium AI users are growing fast, up 50% year over year, but management itself admitted this dampens ARR in the short term, which is corporate speak for. We're adding users, but we're not making as much money off each of them, and that's really the crux of the entire story. AI hasn't destroyed Adobe's user base. It's destroyed Adobe's pricing power. When anyone can generate a decent image for free with a basic AI tool, the case for paying a premium monthly subscription gets a lot harder to make, no matter how good your version is. Adobe's own stock photo business, once a quiet but reliable earner, has reportedly seen a steeper decline than the company itself expected. Another small sign that AI is eating revenue streams management didn't even flag as vulnerable a year ago. Then there's Figma, the wound Adobe inflicted on itself. Back in 2022, Adobe tried to buy Figma outright for $20 billion, the largest acquisition in its history, essentially to neutralize its fastest-growing competitor before it became a real problem. Regulators in the UK and EU killed the deal, forcing Adobe to pay Figma a $1 billion breakup fee and walk away empty-handed. Figma then went public in 2025, popped 250% on its first day of trading, and is now valued at nearly $68 billion. Morgan Stanley analysts now call Figma the industry standard for product design software, a title that used to belong to Adobe without question. Canva has been eating from the other end of the market, winning over casual users and small businesses who never needed Adobe's full toolkit in the first place. Adobe is now fighting a two-front war against companies built for the AI era from day one, while dragging along decades of legacy software architecture that simply wasn't designed for it. Trying to buy its way out of that problem again, Adobe has agreed to acquire the marketing analytics platform SEMrush for close to $1.9 billion, a much smaller and much less contentious deal that cleared its first regulatory hurdle in Germany, but one that shows just how badly the company wants a second bite at owning an adjacent piece of the workflow before someone else does. On top of all that, Adobe is also facing a class action lawsuit alleging it trained AI models, specifically its SlimLM system, on a dataset that traces back to nearly 200,000 pirated books. Adobe says the training data came from a legitimate open source. The plaintiffs say that source is itself built on stolen work. Either way, it's one more legal cloud hanging over a company already trying to convince investors it can be trusted with the next decade of AI development. Narayan's exit crystallized all of this anxiety into a single headline. He didn't leave in disgrace. He built Adobe from under $1 billion in revenue to more than $25 billion, and he stayed on his board chair to manage a smooth handoff, with the board's lead independent director now running the search for a successor. But the timing tells its own story. Fortune framed it plainly. His departure was caused at least in part by investor impatience with Adobe's AI transition, arriving in the middle of what one report called the SaaSpocalypse, a broader sell-off hitting every per-seat software company whose entire pricing model assumes AI can't do the job just as well. Adobe wasn't singled out because it's failing. It was singled out because it's the biggest, most recognizable name sitting closest to the blast radius. Here's where it actually gets complicated, because the bear case and the bull case are both true at the same time. Adobe trades at roughly 13 to 16 times earnings, less than half of Microsoft's multiple, despite growing revenue in the double digits and generating record operating cash flow of nearly $3 billion in a single quarter. That's not the valuation of a company in freefall, it's the valuation of a company the market has already priced for the worst-case scenario, whether or not that scenario actually plays out. Adobe has leaned into that gap itself, aggressively buying back its own stock while the price stays depressed, betting that its own shares are cheaper than the market thinks they should be. If Firefly keeps converting freemium users into paying subscribers, if the incoming CEO can restore some confidence, and if the AI threat turns out to be a margin problem rather than an extinction event, Adobe at these prices could be one of the more interesting turnaround stories in software. If AI keeps eating Adobe's pricing power faster than Firefly can replace it, this could be the long, slow unwind of one of the most dominant creative monopolies ever built, in real time, in front of everyone. What makes Adobe such a useful case study isn't that it's uniquely doomed. It's that Adobe did almost everything a legacy software company is supposed to do when disruption arrives. It built its own AI. It embedded it directly into the product. It kept growing revenue the entire time. And the market still punished it by almost half. That should terrify every other software company, still betting that owning the workflow is enough to survive the AI era. Adobe spent 18 years building the wall around its garden. The question nobody can answer yet is whether AI just found the door or whether it tore the whole fence down. That's the story so far, and it's still being written in real time with every earnings call. If you want to see how this same AI disruption is playing out across the rest of the software industry, go check out our video on the SaaSpocalypse next.